Good morning, everybody. Welcome to this webinar, which is a snapshot of the UK investment climate. My name is Christina Liaus. I am the Regional Director for the Department for International Trade and also responsible for European investment into the UK. As such, I oversee DIT's investment operation on the ground in 25 countries across Europe and Israel. This morning, I'll give you a quick introduction to the UK investment climate that we are here to discuss today, seen from a European foreign direct investment perspective. And what a fascinating perspective that is, especially these days. The investment environment for the past couple of years have been hit by a number of hurdles: EU exit, a global pandemic, and now, unfortunately, the unrest in Ukraine. But what does that mean for international investment flows? We at the UK government naturally observed the investment flows closely during all of these time, the last couple of years, and reached out to loads of companies to speak about their investment plans in their field going forward, which sectors would continue investing and which would not. As we all know, uncertainty really is the enemy of investment. And during the last couple of years, we certainly saw that some companies took their foot off the investment pedal and just awaited more market clarity and stability. But at the end of the day, and when we did the final tally, we saw only minor changes to the investment performance from Europe into the UK. For example, in the financial year ending in March 2021, DIT recorded 500 European investment projects into the UK, accounting for an injection of £12 billion worth of capex investments and the creation of 27,000 new jobs all across the UK. In addition, we landed over £4 billion in capital investment. That was the financial year 2021. This year, the year after, when EU exit was truly settling in, and during the pandemic, in the financial year that ended in March this year, 2022, we recorded a few more European projects into the UK, namely 515 to be exact, accounting for a significant increase in capital expenditure, namely £18 billion worth of capital expenditure into the UK and 24,000 new jobs created. In addition to that, we landed £12 billion of capital investment, so significantly more than the year before again. And during both of those years, the companies that established significant projects into the UK came mostly from the energy sector. We work on a number of offshore wind projects. You have probably heard about the Dogger Bank project from Norwegian Equinor, or the Ørsted project, the Hornsea project that Ørsted is delivering. But we also work on nuclear projects, waste to energy projects, and many other of this type of projects, for example. But other sectors are also performing well in the UK: telecommunication, transportation, road, air, retail. And for capital investment, it's worth noticing that real estate is still happening and UK redevelopment is still happening, and we see injections by pension funds and so on from all across the European markets. In fact, during my time with DIT Europe, we have never registered such injection of both capital expenditure, capital investment, and creation of new jobs from European companies. And I'm sure that Matt later on will cover some of the reasons why the UK remains such an attractive investment destination for European companies. But just let me mention a couple of reasons why I think that is. First of all, I think that clear government policies and ambitions set the scene for investment opportunities. When the government launched, for example, their 10-point plan for a green industrial revolution in November 2020, this sent a clear message to the market about the UK ambition. In the plan, the UK was the first major economy to embrace a legal obligation to achieve net zero emissions by 2050. That is exactly the type of signal that the market, that the private sector companies are looking for. And perhaps one of the reasons why we see that many energy projects are happening in the UK these days. And therefore, of course, we paid extra attention to the arrival of the new Prime Minister in the UK just a few weeks back. And I was really pleased to see Liz Truss when she launched her growth plan just last week on the 23rd of September, because there is really nothing more reassuring than political certainty and stability for foreign investors. So the growth plan announced that the UK corporation tax, for example, would remain at 19%. Such a competitive business tax support both investment, innovation, and economic growth in the UK. since maybe you know, maybe you don't, since 2010, the rate of corporation tax has been reduced from 28% in 2010 to 19% in 2017 and going. And the result is that the UK has a corporation tax rate that is significantly lower than the rest of the G7 countries. And also to further business support, to support the business to invest and grow in the UK, the government will make permanent the temporary 1 million level of the annual investment allowance, which was due to expire next year. This will support businesses to invest and provide companies with more stability and make tax more simpler for any business that are investing between 200,000 and 1 million in plant and machinery. It means practically that businesses can deduct 100% of the cost of plant and machinery of up to 1 million in the first year. And that is nice to do. And finally, the Seed Enterprise Investment Scheme, which encourages innovation by granting private investors a significant tax break when they invest in early stage companies. From April next year, the companies will be able to raise up to £250,000 of CIS investments. That is a 2/3 increase. And private investors will be able to invest £200,000 each year, doubling their investment limit. And these changes hopefully will help over 2,000 companies per year to use this scheme to fuel innovation and fuel growth. And I'm sure that Shantanu can elaborate on this scheme much further than I can when he speaks later on. But it is this type of government policies that create certainty for investors to make investment decisions and venture into new projects in the UK. And then we are naturally going to speak about the National Security and Investment Act, which came into force in January this year. The NSI Act, as we call it, gives the government powers to scrutinize and intervene in business transactions, such as takeovers, for example, to protect national security while providing businesses and investors, again, with certainty and transparency that they need to do business in the UK. The UK investment screening is relevant for 17 mandatory areas of the economy. It is sectors such as advanced materials, robotics, AI, nuclear, authentication, quantum technologies, just to mention a few. And the investment screening mechanism has now been in operation for around 9 months. And I know that both Nikolai and Paolo and others here on the panel they are experts in this and will speak more about the investment screening during the deliberation here this morning and what this has meant to investments into the UK. But in conclusion, it is my hope that by the end of this meeting, you will know more about the current UK investment climate and why you and your clients should consider investing in the UK and who to contact when you want to set up in the UK or acquire UK companies. So now, without further ado, let's get this meeting started. Please all welcome our host and moderator, Nikolai Juel Hansen, partner at Magnuson Law. Nikolai, the floor is all yours.
Thank you very much, Christina. Sharing now a few slides. First of all, welcome on behalf of the British Chamber of Commerce in Denmark. This event is the inaugural event by the newly established legal committee that I'm very proud that I have been asked to chair. And we will, in the coming years and months, make a lot of events focusing on legal issues between Denmark and UK. The British Chamber of Commerce in Denmark is a non-for-profit member organization and, as we say it, the gateway to support trade between the UK and Denmark, and the place in Denmark where both British expat professionals and Danish, British and other international business leaders collect. There are a number of very good events in the annual calendar of the Chamber. I know that if anyone has an interest in speaking to the Chamber, not already members, Mauricio will share the contact details of Gareth Garvey, who is the CEO. There is, of course, a lot of fantastic treats in the Chamber. We create business opportunities by facilitating connections. We, of course, have excellent relationships with the British Embassy in Denmark and the DIT, as expressed by of course, this webinar. As a member, there is access to research done by the global network of British chambers, and of course, focusing on Brexit, there is a detailed post-Brexit trade expertise. Gareth will be able to tell you all about the different membership categories should you wish to have a further conversation around that. We're not focusing on Danish law today, but I just wanted, as a sort of maybe an appetizer for the discussion that Paolo will have around the investment restriction legislation, give you just a bit of background on the Danish system, focusing on UK, for instance, investments into Denmark, where basically all foreigners, including Danish companies with foreigners in the ownership, are now under scrutiny by the Danish government in terms of investment transactions. The shares or the slides will be shared so that you can see it, because we're not going to be able to cover a lot on this. Then Denmark has, as the UK, defined a number of critical sectors, critical technologies, and critical infrastructure components that is shown on this slide. There has been an attempt by the Danish government to add a bit of further flesh to the bone on the components within these categories that are specifically subject to scrutiny, and while we're not able to dive into that today, we can of course elaborate on that in another session. And in terms of the investment transactions covered by the Danish system, we are looking at any foreigners, also EU companies, where a foreigner either buys a Danish company fully or partly, or injects money into a Danish company, as long as the control obtained by the UK or other foreign party is 10% or more, or similar control, which also sees transactions below 10% sometimes being subject to scrutiny. We don't have any lower monetary thresholds in Denmark for this, so it basically starts from kroner 1. And there is a slide here also covering a lot of other transaction types where the Danish government wants to scrutinize. Predominantly so one where we see loan agreements with covenants trying to control the company, it being extended the loan, potentially also being subject to FDI regulation in Denmark. I don't want to add more detail at this point in time, but rather pass on the word to the next participant, and then looking forward to moderating the panel at the end of this event.
I think that's my cue, is it?
That's right.
Okay, thank you. So hi everyone, lovely to be with you today. My name is Matt Cross. I'm a director in EY, but working permanently with Department of International Trade to deliver foreign direct investment support to overseas businesses investing in the UK. And one of our jobs is to be helping DIT, Department of International Trade, define why the UK is a great place to invest in. So give me 1 second while I just share my screen so you can see our slides. So as Christina says, this is an interesting time to be supporting overseas businesses investing in any part of the world. There are a lot of disruptive forces out there at the moment, like global inflation, war in Ukraine, energy shocks, and so on. But our job is to keep the message of the UK out in the global market, to keep this sort of vibrancy of the UK market clear and understood, and really as I'll explain in a minute, we are kind of reassured over the past few years that the UK remains the most popular destination in Europe for investment, as well as one of the most globally recognized international markets that investors tend to flock to, particularly in times when there is turbulence and disruption in the market. And really the reasons for that are across these 6 factors, which I'll go into in a bit more depth in the course of this conversation. So starting with the first of those, just the UK economy as a whole. We are the 5th largest economy in the world, 2nd largest in Europe, with a kind of a total economy size of about 3.7 trillion, with the 2nd largest population in Europe of 67 million. So a relatively small country, but very significant number of people living there, creating a very significant market. And that's those 2 factors, not in themselves, but are very strong contributors to the fact that we are ranked as the 2nd most attractive European investment destination after Germany. We tend to oscillate between 1 and 2, and over the past 10 years, we have consistently been at number 1 most attractive investment destination. And secondly, we are the most popular destination for new overseas investment within Europe. So ahead of France, Germany, Spain, all the other major markets, and that's again because of our history of attracting investment, and for the conditions that the UK creates to allow investment to thrive in the UK, which again I'll elaborate on in a second. Christina mentioned the growth plan for the UK, which was launched just last Friday, following the arrival of our new Prime Minister. That plan is really rocket fueling the existing openness that the UK has to overseas investors and to investment generally in the UK. And Christina's just talked a little bit about some of those factors. And we will see, as time goes on over the next month or 2, more and more tools and policies being brought out to make the UK as attractive to investment of all kinds, but including overseas investment as possible. Christina has already talked a bit about the tax offer in the UK. So we have the lowest corporation tax in the G20. That is committed to in the long term. We have very friendly capital allowances, possibly the most business friendly in Europe. Christina mentioned the annual investment allowance cap, which has been retained at £1 million per business. That was a cap that was increased from £200,000 in the COVID recovery period, but the government is committed to making that a long-term allowance and hugely generous. That goes alongside the super deduction policy, which is allowing businesses to reclaim 130% of the tax payable on any capital investment in goods and equipment. That essentially will save about a quarter of your tax liability whilst investing in the UK. So quite a significant benefit in that alone. Alongside that, if you're in innovation, if you're a high growth business where you need to secure a business, again, Christina talked about some of this, Seed Enterprise Investment Scheme, as well as various other, which I won't go into, schemes that allow you to raise capital more easily in the UK, with various banking restrictions lifted, and other venture capital schemes in place to make it easier and less costly to raise money out of the markets. Alongside that, there is lots of R&D and innovation incentives. R&D tax credits have been around for a while, but alongside that, patent box, all of those in the UK are very competitive and allow businesses to use the UK as a place to develop and create capability. And I'll talk a bit more about the UK's innovation capability in a second, which is amongst the best in the world. So in terms of that question, UK's innovation is amongst the best in the world, as I've said. According to the Global Innovation Index, we rank 4th, so behind US, Singapore, I can't remember the third country off the top of my head, but very well out in front in terms of the global innovation, and you can see how that works out in the column on the right there. So the structure of how the rankings work is based on an innovation index, which is looking at the innovation ecosystem, the financial markets, the education system, the collaboration between education and the commercial sectors, so the knowledge transfer and the R&D and patents within that. The UK, within Europe at least, is well ahead of competitors and really is quite far in front globally in that. The other factors are about human capital and research and infrastructure. Again, UK does well on infrastructure. I'll talk a bit more about that in a second. And of course, with human capital and research, our universities are amongst the best in the world, which we'll come on to. And the knowledge transfer coming out of universities are very well advanced, and a lot of very effective systems, knowledge transfer partnerships, knowledge transfer networks, which are built by government to foster that level of that transfer from university into the private sector. And you can look at lots of different cases. Where I've come from in Bristol, and the links between the University of Bristol and, for example, the aerospace or the energy sectors are very clearly defined. And the collaboration and formal collaboration between university and those sectors in Bristol, but not just Bristol, but across the UK, are very effective in terms of how the commercial sector can acquire that knowledge. The financial markets are also hugely mature in the UK. As you can imagine, given that London's preeminence in the global financial market scene, these amongst the top global markets, vying with New York at number 1, and the VC market in the UK in particular is very significant. Certainly the most significant in Europe, and you can see 40 billion raised there in venture capital in the UK in the past year. And that is as you can expect, a vital part of a vibrant innovation environment. The UK government has fully committed to creating more value out of its R&D as a contribution to GDP. There's a target of getting to 2.4% of GDP by 2027. And a number of policies and directives are in place to help to kind of get us to there. I have no doubt that we will see more as the growth plan emerges over the next few months. But we know that the UK is looking to commit about 22 billion per year to public R&D investment. And an innovation strategy was rolled out last year, looking at some key strands where the UK is strong and where the UK has a need. So areas like AI, energy, nuclear energy, clean growth, offshore wind, and many other 4 or 5 others have been identified as focus areas in which public sector, education sector, private sector will all come together with this public sector commitment of 22 billion to kind of speed up the drive towards that 2.4% of GDP by 2027. I've already talked a bit about defunding and tax incentives. and I'll come on to the knowledge base and research infrastructure in just next slide. So really the kind of the environments that are driving that capability comes from universities in the UK, and the UK is well known for having a very strong university sector. The top five universities in Europe are from the UK. The University of Oxford, University of Cambridge are 1 or 2 and 3 in the world, and University College London and University of Edinburgh are all in the top 10 as well. So these institutions are ranked largely by their research capability and the diversity of their research capability, and that research is fundamental to how the UK is going to achieve the 2.4% of R&D in GDP. The challenge that we've got is making the private sector, commercial sectors, adopt that R&D, and that's where the government's investment is going to focus on over the next few years in translating and transferring that knowledge into the private sector, and for that, the foreign direct investment, businesses from all around the world accessing that capability and talent is critical. And so the government's attention to supporting overseas investment is a major focus. Related, of course, to the university's capability is the talent base in the UK as a whole. Clearly, the UK is a knowledge economy. It's a high-skilled economy, and our people are what makes us competitive. We are also an attractive environment for talent to move to the UK. You can see there on the right that the UK ranks 3rd in Europe for brain gain. So that essentially means people from around the world that are looking for jobs internationally, they will be looking in the UK ahead of most other European nations. So the countries that we rank behind in Europe are Luxembourg and Switzerland. So some of the more niche countries, and certainly we are the most significant economy that people are interested in from around the world. And it will be because of the talent base that we already have and the high knowledge jobs that are available in the economy. Related again to and important to the innovation and environment in the UK is, of course, making sure that we've got a strong infrastructure, both in terms of digital and physical. In terms of our data economy, we are Europe's largest and fastest growing data economy. We are well ahead of all competitors, and growing at a faster rate than competitors, which reflects the importance of the digital economy in the UK, as well as the importance of the digital economy to the rest of the world, and reflects why the UK is a popular destination for innovation investment. The infrastructure to support that is mature. 95% of premises have super fast broadband, and the UK is well advanced in its rollout of 5G, as well as being at the forefront of development of 5G capability. We have a for a relatively small country, but naturally with a large population, we have a lot of airports and obviously ports. Those airports are very globally connected. The DHL do an annual report on connected economies and ranks the UK as the 8th most global connected economy in the world, and that's largely because of its global links and the heritage of the Commonwealth. So links out across all parts of Asia, Americas, which is then physically supported by its airport connectivity. So it's not just Heathrow and Gatwick, it is also Glasgow and Manchester and Birmingham, Edinburgh, Belfast have all got well-connected international airports and ports. But the government is aware of a need to do more, and there is a huge pipeline of investment in physical and also digital infrastructure over the next 10 years. So it's 376 billion pounds of investment in roads, rail, and building infrastructure over the next 10 years, which is a reflection of the growing economy and the ambition of the growing economy over the period. And one thing I haven't said is that the UK, the growth plan that the UK has set out is to get to a steady state of 2.5% growth every year in the next 4 to 5 years. Physical infrastructure, investment in physical infrastructure is critical, and that is really one of the major investment opportunities for businesses of all kinds. If you're in energy, if you're in innovation, if you're in technology, there will be opportunities to capitalize in the UK market over the next 5 to 10 years.
Matt, just being conscious of time, you are very close to the end of your timing. So just so you're aware.
Okay, I'm on to this is my second to last slide, so I'll fire through it very quickly. All I was going to say on this slide was we have London tends to be the preeminent place that everyone recognises in the UK, but the UK offers so much more than just London. We are essentially 4 countries: England, Scotland, and Wales and Northern Ireland. And each of those have got a vibrant and diverse economy in their own right, but also within England, Manchester, Bristol, Birmingham, all centres of significance in their own right that warrant attention. I'll finally just move on to what we can do and how we help. DIT is here to help businesses. We're here to provide support and guidance to help you understand how you can access the UK's opportunities, to help you understand what the UK's opportunities might be. We will work directly with you if we can see that you will bring wealth, investment, and capability to the UK economy. We'll work with you in accessing market opportunities. We'll connect you to the organisations and the businesses that will help you to capitalise on that. We'll work with you practically on setting up in the UK, which will include finding a base, finding facilities, identifying the right locations in those locations I was just talking about, making sure you're structured right for tax, working with you on visas and immigration and any of the complicated parts of investing overseas, and of course in recruiting the right skilled staff. And where necessary in helping you to access the finance that you need to access. So the UK is very well set up to help businesses create a thriving and profitable base in the UK, in the understanding that we know it's complicated. Any overseas market is a complicated place to expand to. So we work very hard in making it as easy as possible for you to do that. And that is the end of my slides. So hopefully I have not overstepped, but happy to take any questions when we get to it.
Thanks, Matt. Only slightly. So, but thank you very much. That was very good. And then over to you, Paolo, on what restrictions we are seeing at the moment in terms of that foreign inflow of funds.
Perfect. Thank you very much. I'm Paolo Parmigiano. I'm the competition partner at Taylor Wessing here in London. And as it's already mentioned before, we have a new act that deals with investments in the UK. And in the next 10 minutes, I want to give you first a short summary of the Act, and then I'll move to what are my personal reflections on how it's working after 9 months. So the National Security Investment Act 2021, NSI, entered into force in January 2022. It is not a foreign direct investment regime, and that's important because it is a national security regime. So, for example, it applies to investors of any country, including UK companies. And you can distinguish two parts in the way it works, a mandatory and a voluntary part. The mandatory, let's start with the mandatory. If the target being acquired is one of the 17 key sectors, and some we already mentioned before, AI, defense, critical supplies to government, transport, nuclear, and are within the definitions which are set up by government for each of those sectors, for example, an airport with more than X passengers, then a filing to the government is mandatory. There's a few points which are important. First, it's irrelevant whether the transaction raises national security issues or not. The targets in those sectors with the definition, a filing needs to be done. As I already said, the nationality of the buyer does not matter, and the threshold starts very low. It starts from acquisition of shares of voting rights as low as 25%. And there are heavy fines for non-compliance. The transaction is deemed void, and the parties cannot complete until they get clearance. That's one part. Then there's a voluntary part. In those scenarios where, for example, the target is active in the 17 key sectors, but not within the definition, for example, a smaller airport, which has a smaller number of customers, or for targets which are active in any sector of the economy, the parties can voluntarily notify if the transaction raises national security issues. There are no fines for no filing, but the government has the possibility to call in the transaction for review for a period of 5 years, which is reduced to 6 months if they become aware of the transaction. A couple of points I think still important about the Act. It doesn't apply only to acquisition of companies, but also applies to transfer of land and IP. You can understand why, because there might be land close to military installation, or there might be IP, intellectual property, which might be used for military applications. So the government is vetting also those transactions. It applies also to intra-group organizations. So even though the qualifying entity, the target, doesn't move within the group, if the ownership changes within the group, even 100%, then it has to be filed. And most importantly for the audience here, it has extraterritorial application. For example, it could even capture a transaction between a Danish company and another Danish company, or a Danish and a German, if the target is active in the UK and it's active in one of those 17 key sectors. What's the process? There is what I call a phase 1, 30 working days, where the government will review the transaction once it's been notified. If the government believes there are national security issues, then the transaction will be called in for a sort of phase 2, which lasts another 30 working days. And if the government needs more time, with consent of the buyer, there can be another 45 working days. And what are the outcomes? The outcomes are the ones we can expect. There could be clearance with condition, or prohibitions. While it is obvious that UK to UK transaction or transaction with European players are likely not to raise national security issues, if the buyer is from countries that the government calls hostile countries, it's a term they use in the guidance, a transaction is more likely to raise national security issues. And just for information, the process is not public except if there are prohibitions. So that's a short summary of the Act. So how is it working? What are my views? I think it's been a radical change for the UK, because we had a regime which captures a few sectors, and it was very light touch. Only 12 transactions were captured in the preceding 20 years. We've now moved in quite an opposite direction, with a regime that captures a large amount of transaction and giving the government an oversight of what's happening in the economy. And I have to say, the UK is not alone in this. You know, it's happening all over the world. FDI regimes are increasing in numbers, and I think that's obviously due to the global political situation. But I have to say that it doesn't mean, in my view, that the UK has become a more difficult place to do business. It's still, as you've heard, and as the government is very keen, the UK is still open for business. And in fact, it was interesting to note that the day the Act came into force, the government also published a paper stating how they would welcome investment from China and what Chinese companies should do. But January in these times is quite a long time ago. And in fact, there have been 2 prohibition decisions since January, and a few more are being investigated, and the buyers were all Chinese. So clearly, slightly different scenario. And just to give you a flavor of what it is that the government has been concerned, the first was a license agreement between Manchester University and a Chinese company. And this technology, the technology the university had, was basically a vision chip that could create and enable new generation robots, which could have military and civilian use. So obviously the government thought giving this license to a Chinese company for worldwide manufacture could be a security risk to the UK. And the same month, it's August, the government blocked the takeover of a UK firm, by Hong Kong-based firm, of an electronic design company, the software producing software that can be used to build circuits. And at the moment, the government is reviewing the Chinese takeover of a company in Wales, which is the UK largest semiconductor plant. I mean, it goes without saying that a piece of legislation like this has increased business for burden. It captures a lot of transactions because they're very wide and key sectors of the economy. And interestingly enough, this burden is bigger for small and medium enterprise that clearly are not used to this sort of regulatory filing. Larger companies are used to do filings across the world. And what we are doing nowadays, I mean, part of my job is obviously checking if every transaction is captured by the regime or not. And sometimes have difficult conversation with clients explaining why, if they are one in those 17 key sectors, maybe they're a small company and they are clearly not raising any security issue, they feel they need to notify. But there are positives. Not everything is. First of all, it is an easy filing. The required information is very, very simple, not complex to gather. It can take a couple of hours. The government has been very good in respecting, in almost every transaction I've been involved in, the phase 1 deadline of 30 working days. So they give business certainty that within 30 working days, they will know if the transaction can go ahead. And I haven't seen this piece of legislation still having an impact on investment in the UK. Clearly, there are a couple of difficulties in the new regime. It's a new regime. We're all starting to work with it. And maybe there are difficulties sometimes to assess whether a transaction fits into one of the 17 key sectors or not. And obviously, business has the habit is used to prefer to err on the side of caution and notify if there is uncertainty. And maybe the highest burden, what is perceived by business as the biggest burden in all this regime, is not the filing, is not the supervision by the government. It's actually the fact that they have to wait 30 working days before completing if the transaction is captured by the mandatory system. So basically, for lots of transactions nowadays, signing and completing is not the same day. On the same day is no longer possible. I mean, that obviously is captured in the SPA, in the documents that are prepared. So it's not, but it's one thing that business do perceive as an issue. And obviously, since many transactions are captured, the unit in government, which is dealing with this at the moment, is getting a lot of work. But as I was saying, this is month 9 of this new regime. And clearly, the government is very keen to refine once they learn how it's working. And there are areas for refinement, which obviously will be introduced hopefully quite soon. For example, reducing the number of transactions which are captured, focusing on the most likely to raise national security issues. So in a way, my message is let's watch this space and let's see what happens in the next few months. Thank you very much.
Thanks, Paolo. That was timed, I think, 10 minutes and a couple of seconds. So thank you very much. Well done. Shantanu, VCs in the UK and opportunities there. The floor is yours.
Thank you, Nicola, and thank you, Paolo. So I'm going to try and try and get us back on track. So let me hopefully share these slides. I hope you're able to see the slides that I have just clicked on the screen, or maybe not. I'm not sure if you're able to see it, but hopefully now you should be able to see it.
It's good, Shantanu.
All good? Okay, great. Perfect. So just wanted to share a few numbers on the venture opportunity in UK and why it should be your top overseas destination. So I'll try and be quick, but there are some numbers here and happy to elaborate on everything that I'm talking about during the panel discussion. So the first point, which I think is probably known to all of you, but would be good to actually get deeper into this, is it's a very dynamic market in the UK with extremely levels of funding and the virtuous innovation circle that actually gets together talent, has scale-ups, R&D effort, as Matt and Christina both alluded to, and all those things together to see these numbers that you'll see in the next few slides. So you see the venture capital activity last year was a record year for UK with almost 35 billion pounds invested. These numbers are slightly different depending on which source you look at. So I know Matt mentioned a number of 40 billion and others would say $40 billion, but the main point is that it's a very high number. And a lot of that is driven by this pool of talent to the 2.5 million people in higher education. And again, Matt talked a little bit about the universities and the research that comes out of that. So that's what drives this. And then, of course, the tech sector itself is a very significant part of the economy. It's almost $1 trillion, which has been valued to is the value of the entire industry, which is a milestone. It's probably number 3 or 4 in the world today. So obviously, as a result of all this, this is kind of consistently ranked as the #1 attractive investment destination in Europe, as Matt, Christina alluded, and most of you would know that. And as you are seeing, as a consequence, a number of overseas VCs actually setting up an office here, establishing a base, having a permanent presence to be able to better address the opportunity. So I'll talk a little bit more about that in the slides to come. So what's driving this? As I said, there's 5 universities in the top 20, which Matt actually listed them. Drives a lot of funding. 35 billion, we mentioned that before. Companies very and into scale-ups, 100 unicorns, 100 plus unicorns actually, more than any other country in Europe. And I think probably a third of all European unicorns are actually British-based. And then, of course, there's a population which creates a very good virtuous cycle of innovation, funding, scale-ups, and the market opportunity. And then you see on the right these circles. You can see how rapidly it has grown from 2019 to 21. What is worth bearing in mind is that this growth came in the middle of COVID and on the back of Brexit. And you see the next slide, which shows the investments over a decade, the last decade in UK, and you don't see any impact at all of Brexit, which is something that a lot of people wondered about. And to be honest, we are not sure about it either. But you can see even between 2016, 17, 15, and I mean, there's a consistent growth. And then, of course, 2021 has been an extraordinary year. It's almost doubled that of 2020. So unsurprisingly, it compares very well with other European countries, whether it is the number of deals that you're looking at over time, as you can see here, significantly outpaces most countries globally, actually, other than US and in China. And whether you look at in amounts invested, it is kind of the same story here. Okay, so all in all, a very dynamic, very attractive, very appealing market. But there's one thing which I haven't talked about, which I think, at least for the professional investors among you and the funds, is probably on your mind. And that question, or why invest? Of course, all these things are there, but the one thing which I have not touched on, which actually is the next slide, is the returns. And this probably is a surprise to most of you, but the returns in UK venture today, they are actually at least on par or sometimes even better than US venture funds. And this comes as a surprise to a lot of people who assume that European and basically non-US venture funds underperform, and that's definitely not the case. But even better, the returns are actually improving over time. So you see this circle from 0.79, which is actually the distributed DPI multiple for the funds, is actually improved from 0.79 to 1.05. And of course, most of you would know what DPI is. It's distributed to paid in capital. It's basically a multiple of what you put in and what you received. So the funds are performing very well, even when compared to US counterparts. And as a result, of course, you are seeing some very large funds being set up. I mean, sorry, on this slide, you can see UK VC, the bullet saying VC firms are breaking funding records, with venture firms raising $7 billion in 2021. So these funding rounds are, of course, driving mega deals. And the mega deals are companies that have raised at least 50 million or more. And you can see these are just some representative names. These are not just the only names that have raised large amounts. Of course, there are many others. And these are the companies that actually are being prepared by this capital, by international investors, and especially very large funds, leading to, of course, the unicorns that we talked about previously. So this is a research from BVCA that was published last year. And this actually is a vintage of 2002 and 11. The previous slide was a vintage of 2013 onwards to 21. This is slightly a bit more earlier from that, from the one cited that I showed before. Now, you might wonder why I'm showing you returns from 2002 to 11, but of course, again, all of you, I think, know that these VC funds are 10-year funds. So it takes a long time before you actually figure out what the returns are. But this research from BVCA showed that returns are slightly ahead of the US for the 2002-11 period, which is surprising to a lot of people. And this probably is the most compelling reason why I think you should be looking at UK. Now, of course, this has been picked up by international investors, and so there is a growing interest as a result of everything I told you just now. If you see over the last decade, you see the activity of international investors and the proportion of deals. Today, almost 45% of growth deals have international investors. This is the green bar line on the chart here. And on the left. And then if you look at venture, today, the growth in number of deals between the last 10 years is almost like a 6 to 8x increase in the number of deals that involve overseas investors. The one other thing I wanted to highlight on this slide is if you see the dark blue line on the left chart, you see the seed investments in which overseas investors participated. And this is fascinating because most overseas investors do not come in at this early stage. They usually prefer venture or growth, but even at seed, you are seeing over 20% investments where international investors are present. So unsurprisingly, the sectors where these people are flocking to are a number of them, actually, not just one. You are probably aware of at least one or two of them. There are kind of UK leads in them. But before I show you the sectors, I just wanted to kind of highlight once again how the venture industry in UK is actually kind of one of the world-leading sectors in the UK economy. And then that is the sectors which I mentioned, of course, fintech. Most of you know that. I don't want to spend too much time on these slides. I'm conscious of the time limit, but you will have a copy of all these with a lot of numbers and statistics here. So fintech, obviously, AI, increasingly, these two were standard, have been around for a long time, but increasingly you are seeing clean tech, which not a lot of people associate with UK traditionally, but you're seeing a lot of activity here. And then, of course, there's life sciences, which has been around for a very, very long time. So those are some of the sectors that's driving this momentum, that's driving this dynamism. And this is perhaps the best time to be looking at UK. If you see the opportunities that I shared before, the sectors that are coming in, the funds that are being raised, and the international investors that are flocking together. So the last slide I just wanted to share you is what can we do to support you in this ambition, in this desire that you may have to look at UK and expand your operations there from a venture perspective. So there are a few things we do, and I'll be happy to talk more about this during the panel discussion. But essentially, it's about curating high quality investment opportunities. That's a big part of what we do. Then obviously connecting you to the ecosystem, the venture ecosystem, which includes advisors, of course, peer investors, co-investors, etc. And then the last thing, of course, is making direct introductions and helping you expand your network. We have a small team of 5. I'm part of that team based in London, and we work very closely with colleagues abroad, including Christina, who is on this call, Maurizio, and I also have my colleague in Paris, actually, where I am right now, who is on this call. So we work very closely with all of them to achieve what we do. And this is the last slide. So lookbooks are some of the profiles we share of companies. We call them lookbooks, and these are some of the ones we brought recently. And finally, to close, this is what we achieved. So last year, 660 million of funding was catalyzed by our team. We made over 400 introductions, and each year we support on an average 50 investments, which has been the pace for the last 5 years. So that's the team, and I'll be happy to talk more about this, but thank you all for a patient listening, and thanks, Nikolai, for making this happen. Over to you.
You're on mute, Nikolai.
Sorry. Thank you, Shantanu. We are now heading into the panel part of the event. So if I could ask you, Shantanu, to stay, and then Emma, Camilla, Christina, and Stephen to come on camera. Thank you, guys. So basically, it's a bit more tough to moderate a panel online, but so I guess that you guys will just be basically shouting up when you have input, and of course we would very much like to welcome questions from the floor, so that if anyone has a question, either raise a hand or type it in the chat. First of all, could we just have each of you give maximum 30 seconds of who you are, so that everyone knows that when you're speaking, starting perhaps with we've heard from you, Christina, we've heard from you, Shantanu. So Camilla and Emma, please could you come on? You're on mute, Camilla.
I was on mute. Thank you, Nicola. So my name is Camilla Collett. I'm a partner with the Danish law firm Gorris and Federspiel in Copenhagen. I work with corporate matters, M&A matters, life sciences, and investments.
Thanks. Emma?
Good morning. I'm Emma Davis. I'm the co-CEO here at Octopus Ventures in London. We manage about £2 billion in early stage sort of seed and Series A venture capital investments, predominantly in the UK, but increasingly with a focus on Europe as well.
And Phil?
Hello, everybody. I'm Phil Shepherd. I'm a partner in the corporate technology and life sciences team at the international law firm Taylor Wessing. I'm based in our London office, and we do a huge amount of work with companies expanding into the UK, but also in the venture capital scene in the UK as well as other jurisdictions.
Thank you. I think we have the crew now on board, and I want to apologize up front for throwing you any curveballs that I might be throwing you. But I'll do that. So as a background, I sat in on a briefing by Silicon Valley's Nordic team this morning. It was based on a report they've done with Deal Room called the European VC Pulse Check for the first half of 2022. I think some of the components coming out of that is that VC funding in Europe is still widely available, that investment levels actually in the first 6 months of 2022 is higher than they were in the last 6 months of 2021, which surprised me a bit, but still worse or lower than they were in the first 6 months of 2021. What the report is talking about is more flat rounds and down rounds, but also that the European ecosystem has actually kept its value, increased it a bit as opposed to 2021, clearly outperforming US and Asia that dropped off significantly. What Silicon Valley was talking about is a concept they call CIMITIM, which is an abbreviation of cash is more important than your mother. So with that, and on the background of what Shantanu said, my first question to you guys is, do we have a crisis in relation to investments? And Emma, you are the one sitting on the cash. You'll have a first go at that.
Absolutely. Thank you for that introduction. It was really interesting. No, we do not have a crisis. From our perspective, to your point, there is a huge amount of dry powder. Funds are sitting on a lot of money, and cash is very important from an investment perspective and also from the entrepreneur's perspective. And if we think about the main building blocks that go into building a successful venture ecosystem, you need experienced entrepreneurs, talent, and availability of capital, combined with sort of the culture and ambition and lived experience. We have each of these factors are strengthening for each successful company. And if you look at the UK in particular, there have been about 50 unicorns now, with 25 of those realised in 2021. So that means the ecosystem, in terms of all of those factors, is only becoming ever more mature. So we are still seeing a huge amount of attractive opportunities. We are seeing a lot more discipline, both from the investment side and from the entrepreneur side, which can only be a good thing. So no, I would say from our perspective, definitely not a crisis.
Camilla and Phil, do you share that view?
Well, jumping in, I do share that view. I think you know, the technology sector has become so widespread and matured so much that there are a huge number of really good companies out there, and there are more and more, you know, founders who are repeat founders. They've been there, they've done it before. They're reinvesting in the ecosystem. We're also seeing you know, some in the current climate, we're seeing some later stage investors sort of come back up, you know, back to earlier stage a little bit as well. I think there's a lot of activity. There's a lot of activity to come. Clearly, uncertainty in the markets, and that has had impacts on valuations in some respects, particularly as you get to the larger growth stage deals, as a sweeping generalization, and that again will be different in different verticals. But no crisis from that perspective.
Is that also the case in Denmark, Camilla?
Yeah, I would agree with that statement as well. I think there's a no crisis from our perspective. We still see a lot of activity. As Phil said, I think it's also a little bit hitting valuations at the moment, especially in some sectors where people are perhaps a bit more hesitant, and there's perhaps also still some discrepancies between, you know, expectations as to valuation on both sides. So sometimes that can make it a little bit more difficult to reach a final agreement if there's not full alignment. And then, of course, I will say that, you know, we're living in interesting times, and of course, everyone is thinking that things might look a little bit more uncertain in the future. But for now, we don't feel it in the activity, I would say.
And Christina, Shantanu, and Matt, you know, you guys are sitting at the government bench here. You know, what are your perspectives on this?
I think very quickly from me, I would agree with everything else that there's no crisis. I think the UK has got a huge amount of latent opportunity still in it. The global markets tend to focus very much on London when it comes to raising finance, to investing. The opportunities go way beyond it, and it's the Manchesters and Bristols and Edinburghs that are beginning to come and shine through at the moment, which are bringing out many more opportunities. So place, you know, OVO and Graphcore, two examples of unicorns that have come through in the past couple of years that are outside London, and the opportunity is in those markets.
We see quite a lot of companies, high growth companies all across Europe, who are looking to the UK for raising finance, also for accessing the market naturally, depending on where they come from. But the UK is a very strong market, and if you can make it there, you can make it everywhere. But definitely as a place to raise funds and fuel that future growth that the high growth companies need to internationalize. We see them looking to the UK. We've just been running, or in the midst of running, what we call the Tech Rocket Ship Awards in the Department for International Trade in Europe, which sort of identifies tech companies from all across Europe. And we've had amazing success on that, just running the semifinals for that award here within climate tech and health tech and AI and 6 categories. And what we see very often is that the moment the companies are ready to sort of internationalize, they look towards the UK for that injection that they need of cash, of course.
But coming back to something that Camilla said about, you know, uncertain times, we are seeing inflation, very particular in energy prices. We are seeing war in Europe, explosions in the Baltic Sea. We are seeing supply chain disturbance. We are seeing, you know, a lot of things, China-US relations. how is that impacting on investment appetite? And Shantanu and Emma, maybe first, is the view from PE and VCs, is that different to corporates? And maybe Phil and Camilla, you can elaborate on that as well. But Shantanu, how in your view is this uncertainty in times impacting PE and VC investment appetite?
Yeah, thanks, Nicola. And I'm very keen to hear also Emma's thoughts on this. But Nicola, one thing to say here, first of all, and this kind of goes back also to the first question you asked. I'm old enough to remember people talking about the death of venture capital in 2001 and then 2008 and then 2014 and of course the pandemic. And yet, it survives, it booms, it keeps growing. Okay, why? Because it's a long-term market that's not driven by the next quarterly earning report or call. People investing in this sector, investors, but also LPs, are taking a 10, 20-year horizon view. And yes, but inflation is there, supply chain disruption. These are, I think, evolution of the global economy. Obviously, some of them are more fundamental changes. But then that also creates opportunities for innovation. So I don't think, I'm not pessimistic. Yes, in the short term, there will be challenges. And as Emma said, it has brought discipline into the industry, especially on the company side, which you can argue was missing during kind of the last 15 months or so. But is it at a point where people are saying, no, we have had enough of venture? No, I don't think so. I mean, not at all. I think if anything, it's going to keep growing regardless of the quarterly up and downs. But Emma, over to you.
Thank you, Shantanu. No, I completely echo that. I think clearly has been a shift in investor sentiment at the later stage growth rounds. But that was actually, a lot of that was started earlier on in the year with the sort of the tech rotation in the public markets, and that's the read across to valuations at later stages is where you feel that most keenly. And obviously the world has become more challenging since then. But to Shantanu's point, that generally is a catalyst for more innovation at the early stage. We tend to see a lot of more people like taking a risk actually when the world is a tougher place, ironically. So we are seeing just as good a set of opportunities coming through, possibly a little bit less on the consumer side, where you can, there is more concern about the demand that might be more proximate. But the longer term 10-20 year view is still one that is very exciting, and we're seeing plenty of attractive opportunities.
Phil, any difference in the perception on this from the VC and PEs you work with to the corporates you work with? And Camilla, please feel free to pitch in on that as well.
Well, I mean, your question started, Nicola. Thank you for that. With a long list of all the different headwinds in the economy, and obviously, some of those are continuing, and we don't know how they're going to unfold. Others, we've got a pretty clear direction on what the energy prices are going to continue to be an issue right through the winter and into next year, for example. They've also not really come through to bite yet. It's only the next couple of days in the UK that the energy price cap for consumers is actually going to lift again, and so everyone's sort of gas bills are about to double or triple in the next, literally the next few days, next month or so. So these things are still playing through, and it's very difficult to guess how it's all going to go. But it's also difficult to sort of pick out how any particular one is impacting sentiment for corporates, for investors as well. I think there will be, clearly there are an awful lot of companies that have raised a lot of money in recent years, and they would, in the ordinary course of things, be going for additional financing rounds in the months and sort of year ahead. And there will be some of those that find it more difficult to raise funds. Their runway, depending on their footprint, may be shortened by costs being far higher than they were anticipating in their models and so on. But I would also just emphasize, sort of agreeing with a point that Emma made around the appetite for risk, in that we're also seeing larger seed rounds at the moment. So that is supportive of the fact that VC is there and people do see the opportunities.
And I guess to supplement on the corporate side, I would perhaps also say that any kind of changes also always prompts, new ways of thinking about things and thinking about new markets, reorganizations, things like that. So even on the corporate side, just the fact that things are not necessarily as stable as they were before can also prompt just investments, transactions, things like that.
I'm almost get the feeling that I will come out of this webinar more encouraged than I was going into it. So that's great. Picking up on something Emma said about opportunities, and you as well, Camilla. Matt, opportunities in the market, where are they rising at the moment? Which sectors have gone from, yellow to red in terms of hotness over the last months, also against some of the turmoil we're seeing?
Well, it's a lot of it's driven by what the government is prioritizing at the moment. Innovation is critical, is right up there in the government's agenda, but using technology to create more efficiencies in the market, to help the infrastructure, to kind of to help achieve net zero by 2050. It's really around clean growth and innovation are the sort of hot markets for the UK at the moment. Then you can overlay what is happening in the private sector, what is the market generating itself, and we talked earlier about fintech as being a really key sector for investment in the UK. So and then of course we're looking at automotive and the disruptions of the move to EV. The UK is very ambitious and wanting to be a world leader in the EV food chain, and so there are lots of opportunities in that sort of field as well. So I mean, you could kind of go on at length, but I would say those are the three things: innovation and innovation related to clean growth and automotive are probably the three areas that are most interesting to the UK at the moment.
Shantanu, any additional feedback from you on that?
On the sectors, you mean?
Yeah.
Yeah, no. So I think, I mean, you would see certain sectors picking up more interest, and in particular, I think Matt kind of just hinted at that. I think there will be less activity in fintech, for example, but conversely, you are going to see more of deep tech investments and AI-enabled technologies. So these things change and fluctuate, but I think even the hotness, I mean, the famous Gartner cycle gets revised hype cycle gets revised every few months with the technology up on the swing and then on the down. So I wouldn't worry too much about it. I think most investors take a very long-term view of these things and would be looking at actually not what's hot today. I mean, I'm certain Emma and her team doesn't look at press reports to see what are hot and where to invest in. But yeah, so I wouldn't put too much attention. But as Matt said, I think certainly priorities, climate change and so on are driving some of these new sectors where you will see more and more happening in the days to come.
Did you add or pull away? I think you mentioned consumer, but did you sort of rearrange your investment focus over the last few months here?
No, I mean, we have dedicated sector teams here who are each sort of challenged to go and deploy or invest the same amount of money. But we do obviously sit back and then evaluate the richest of opportunity set. And we are seeing less exciting consumer opportunities at this point in time. Conversely, we're seeing, in addition to some of the areas that have been mentioned, a huge amount of exciting opportunities in health in particular. And albeit with the runway that people are coming now with the round size, to actually speak to Philip's comment, to last them for 24 months, not 12. So entrepreneurs are mindful of the environment and they therefore want to raise more money up front and to give them obviously the ability to exist for longer without having to come back and deal with some of these headwinds that you're alluding to. So deep tech, agreed, the backdrop remains strong, fintech, so it's, and B2B indeed. So I think the only area where we have seen a softening in terms of our assessment of the opportunity set is consumer, but there's still a reasonable amount to be looking at.
Okay, Camilla, sectors in Denmark that are hot, anything that's sort of spiking at the moment based on current financial climate issues?
Yeah, I don't know if I can I mean speak to it necessarily that generally, but I will say just from my own perspective, we still see a lot going on in life sciences. Anything, tech related, anything related to energy, cybersecurity, things like that. So there are definitely some stronger sectors, I think.
Okay. Phil and Emma, you were talking about, prolonging the runway and stuff. Is that impacting on valuations? I listening to Silicon Valley Bank, they were talking about flat rounds and down rounds? What are valuations doing at the moment, as opposed to, you know, the happy days of 2021, at least happy days for startups?
So I mean, as I sort of mentioned earlier, from our perspective at the very early stage, we're seeing less of a valuation impact. The bigger, very marked change has come sort of in the later growth rounds, and particularly with big players like SoftBank and Tiger, who have materially changed their sort of their appetite for some of these sort of outlier mega rounds that are happening. But if we look at sort of median pre-money valuation at seed and Series A, there isn't so much choice. It isn't so much change. If you look at Series A, C and later, then we would say on average, I think that valuations have pulled back to sort of just got rid of the sort of last year's exuberance, really. So we've just sort of stepped back a little bit, but it's not been that dramatic.
I'd agree, Emma. Not much to add to that. I think one feature we are seeing valuation related on some rounds is we're seeing convertible loans being used a bit more, quite a lot more actually than would have been the case in previous economic conditions, really to delay the valuation conversation. So not just using them as a bridge to to the next financing round, but actually.
Yeah, I would agree with that.
And how is that impacting?
Later. Sorry,
Emma. No, how is that impacting startups? Phil, is that making it life more difficult for them, or?
Well, I think in reality they're using it because it's the easier option, because it just delays that conversation, and you allow the company to get the money in. One of the other features, again valuation related, is we are seeing continued interest in looking at venture debt, as well as a sort of more non-dilutive route of getting cash in. I mean, that trend has been increasing anyway over recent years. There are far more providers than there used to be in the market.
And tapping into that, maybe Matt, are this bringing in other unusual features in investment and M&A deals, that you are eyeing from your end? What are we looking at, altering deal terms as opposed to last year in terms of anything else that Phil and Emma has already picked up on?
Well, I'm probably the wrong person to answer the question on whether deal terms are being altered, but where I think I can see some trends is just I suppose it's going back to the point we were making earlier, that there doesn't seem to be any drop off on the interest of investment in the UK, both from a capital investment point of view and from a sort of an FDI point of view. There's a definite sense that the UK, along with the other global and developed economies, is a safe place to kind of shelter in during a period of turbulence. And the EY attractiveness survey that was issued earlier in the year makes that point very strongly, that the UK remains very resilient in that kind of environment. And so all this conversation about how we're kind of retaining the levels that we're seeing is really based on that fact that it's a strong and safe destination to invest in.
And Shantanu, conscious of you might being able to run to catch a flight, any thoughts on this before I pass it on to Camilla? Doesn't seem so. Camilla, what are you seeing in terms of changes in deal terms?
I will say that I don't think that we're necessarily seeing huge changes.
Sorry, Nicola, can you hear me?
Yeah, we can hear you now. I'll come back to you
sorry
in 2
about
seconds,
that.
Shantanu.
Yeah, no, I was just switching back to my phone since I need to leave shortly.
Yeah, I know.
But no, I think, the only final comment I would have is, and I think most investors and funds are definitely aware of it, is there will be short-term reaction to what's going on, all the inflation and other things that you mentioned, and some pullback in certain things. But I think to say that this is going to fundamentally change the nature of angel investment or the activity that we've been seeing in the last, I showed you that chart over the decade, and that kind of belies every pessimistic forecast that you may hear. So I would say, I think keep investing. Do consider UK, and there are sectors that are emerging which are going to be attracting very serious opportunities and seeing innovation in the years to come. So that's all I would say. And yes, of course, we are happy to help, and we are here to help. So please reach out to me or to Christina or to any of our colleagues in case you have any questions or need more detail or need support.
Fantastic. Thanks, Shantanu, and have a safe flight. Camilla, back to you. You were seeing that you're not seeing a lot, but a little.
We're not seeing a lot. I will say what we have seen, I think, over the last couple of months is that since processes and transactions might be taking a little longer than they did before, there is sometimes a need for sort of interim financing, just because things are taking a bit longer than they normally would. So we sometimes end up discussing some kind of debt element also, which we wouldn't necessarily have done before. And that's, of course, a number of factors, not just financial markets. It can also be things like FDI requirements, things like that, requirements for filings, which may take longer than they did before. So it's not just the markets, it's also the legal side.
Seeing the same in the UK, Phil?
Yeah, similar. And I think on that interesting point, picking up on Camilla's note there about timing, we're certainly seeing a number of deals that are taking longer, both on M&A and on venture deals. But we're also seeing the opposite, given the uncertainty in the market on the company side or the seller side. If it's M&A, you're also seeing an awful lot of pressure to get things done as soon as possible, get the deal closed, get the monies moved, etc. And some investor protections. Some more investor or new investor protections, more investor-friendly protection provisions are being requested on a lot of deals. Whether they end up actually in the final documents or not is another question, but we're certainly starting to see those creep in a way they haven't in the market in the last couple of years. Christina, you've got your hand up.
Yeah, just one comment on some things that I think neither Matt nor Shantanu touched upon. In the past, when high growth companies or companies sort of wanting to internationalize came to me and talked about the UK, they immediately said to me, we need to go to London, we need to be in London, and so on and so forth. But now what is happening is that more and more frequently companies find out that there's something really interesting going on in Bristol, or maybe they go to Leeds, or maybe they go to Newcastle or somewhere else, to Scotland or somewhere else, because they need to get their money to stretch longer. And of course, it's expensive to be in London in the first place. So they look at where is the actual cluster of activity that they need to tap into located in the UK. And often it's not in London only, it could be somewhere else. And I see that more and more. And I think that's quite interesting that the investments are spread further afield in the UK. And those pockets of knowledge or university spin-outs and so on that's happening elsewhere is being utilized much better than what we've seen in the past.
Thanks, Christina. Emma, are you putting in more onerous deals terms for the startups in your investment documents now, as Phil alluded to?
No, not for us, because as I said, we operate at the very, very earliest stages, so that doesn't really work. But in terms of the portfolio companies that we our existing portfolio companies, with the later rounds, exactly as everyone has said, we are seeing more and more structured rounds with tranches, milestones, etc., to offset what I guess is a higher perceived risk in operating environment. But at the earlier stages, no, we're not there yet.
Camilla, earlier we heard Paolo speaking about the UK national security system. I kind of alluded a little on Denmark. I know that you work with this as well in terms of a more global overview and all of these systems that are popping up. How are you seeing that impacting transactions from your end? Is it killing deals? Is it delaying deals? Is it another group of buyers? How is all of these FDI restrictions coming into life, basically?
I think we're seeing it a little bit in, for instance, in structured processes, where it's sometimes if you have a number of bidders and some of them are from jurisdictions where you think you might find it difficult to get someone through an FDI process. I think that is the only way I've seen so far where it's actually sort of made a deal not happen. But otherwise, from our perspective, we think it's, you know, it's increasing. A lot of companies are introducing FDI rules, and it's a whole new track, you can say, a work stream in the transaction to keep track of that. So it's more a matter of it's you know, it has a time and cost impacts as we see it right now, but it's not necessarily changing the whole deal dynamic.
Matt and Christina, is this something that you are looking at as sort of limiting deal flows, or is it, as Camilla alludes to, just, you know, annoying?
No, we're not looking at limiting deal flows, but we are having to assess the different deals that are coming through to make sure that there is no, there's nothing that's going to present a risk or create an issue. So we continue to engage with all comers, but we will make an early assessment as to whether there's anything in there that we need to flag, and then we will raise that within DIT to create a decision on it. But no, absolutely, we want to engage with all types of investors at the earliest possible stage, and then we'll work it out from there.
Phil, you and I worked on a Danish one that sort of, and I think from our end, we're seeing this apply in almost half of the deals we are doing in Denmark. Of course, more into the tech sector. But what are you looking at in the UK from that? Is it a complexity? Is it killing investors from certain exotic jurisdictions, or what is that?
Lots of questions there, Nikolai. Thank you. Not seeing any evidence that it's reduced any deal activity, whether that's venture or M&A. It comes up far less frequently in practice on venture, because one of the things that did change between the announcement of the initial bill and the act making its way into legislation was the bottom threshold on percentages went from 15 up to 25. So most venture deals will sort of get through on that. So far, there will be exceptions to that. There are exceptions to that where notifications are required. M&A, you know, an M&A deal is always going to potentially be in scope if you're in one of those 17 sectors, and we've certainly had a lot of conversations. And really trying to get into the detail of whether you're captured within that definition or not. AI has probably come up most. We've had quite a few deals that we've had to notify. The clearance takes about the 30 working days that it's expected to take to come through. The process of actually submitting for it is relatively straightforward. It can take from a few days to a couple of weeks or so, depending on the particulars of the deal, the information flow, and so on. So it is more of that sort of just an extra work stream, some extra time. It can impact on deal timetable. Accordingly, you may need to add up to an extra sort of 6 weeks, 8 weeks or so to get a deal through if you need the clearance. But they do seem to be coming through. There's only been one that's blocked so far at the last count, and that wasn't a venture financing or an M&A deal. That was a technology license. So it seems to be not sort of sticking any investment, blocking things unnecessarily. It's just extra process people have to go through. And the other thing is the extraterritorial piece that Paolo was talking about earlier. It's quite easy if you're, if you've got two Danish companies or two US companies that, one's buying the other, but there's a UK presence, then you can be within the remit of the legislation and need that UK clearance. So we've had a few that have come to us quite last minute where suddenly someone's asked that question and realised actually they've got to go through this process as well. So that's something to watch for.
Thanks. And Emma, are you looking at this as an entry issue for you going into investment, and what are you looking at? How are you looking at it from an exit perspective? Are you more focused on which kind of investors you are getting into companies you're invested in? Are you looking at whether there is a limited pool or more limited pool of buyers at the end when you're going to exit? How is this impacting your views on sort of the investment climate?
To be completely honest with you, given that, Shantanu made the valid point earlier. We come into this with a multi-year time frame, and we've learned over the past that trying to think too far ahead is a bit of a fool's game. It's quite hard to predict the future, and I don't think any of us would have predicted where we are now this time last year, for example. So clearly for some of our entrepreneurs and some of our existing portfolio companies, the conversations around the table have changed. And in terms of the options in front of them, there used to be many, and they probably have, if you are looking for an exit in the next sort of 6 to 12 months, the environment is clearly a different one to the one that we were facing this time last year. But in terms of our sort of mindset about how we think about backing the entrepreneurs from a pretty early stage, quite frankly, nothing has really changed for us. So at some board meetings, yes, the conversation is different, but that's sort of very company specific.
Fantastic. So I think we've actually come to the end of the time frame. Reassured that we don't have a crisis. I'll make sure to reiterate that to people I speak to later in the day. Maybe Christina, a few last words on you summing up, your views on what you've heard today.
Yes, absolutely. Thank you so much, Nikolai. First of all, I'd like to thank everybody on this call, participants, speakers, for your contributions. I think it's been a really interesting discussion. I hope that you now know who to turn to in case you want to either acquire a UK company, find your VCs in the UK, set up in the UK, or do anything else that creates activity on the UK market, especially if you're from Denmark and can speak to Camilla and Nikolai directly. So please do come to us. We're here to help. So no worries, just get in touch.
And on behalf of the British Chamber of Commerce in Denmark, also a huge thanks from me to everyone who spoke and the very interesting discussion I think we had on the panel. Thank you a lot, and thank you for joining the event today.
Have a nice afternoon.
Bye-bye.
Bye-bye.
Thank you. Bye-bye.